Welcome back, financial visionaries and valuation maestros. We have journeyed through the foundations, meticulously crafted our assumptions, and built the interconnected engine of our financial statements. If you have been with us since part 1, you are already light years ahead. If you are just joining, go back and catch up. Today, we unleash the true power of our model, valuation. And for those who are truly committed to mastering this craft, remember, this complete, robust financial model is yours for the taking. Just drop your email ID in the comments below, along with a piece of feedback on what you truly liked about this specific video or the Bankers Bootcamp YouTube channel in general. Your engagement fuels our mission, and the model is your reward. Today, we bridge the gap from financial statements to intrinsic valuation. We'll demystify DCF, leverage comparable company analysis, and arrive at the coveted final share price. This isn't just about numbers. It's about making informed investment decisions, understanding true worth, and delivering the ultimate financial verdict. Let's conquer valuation. So guys, to quickly jog your memory, we started our case study by understanding why Ashok Leyland. Then we had captured the data from the data source vendor screener. So then we captured the asset schedule for Ashok Leyland, which we had captured back into our assumptions with a list of other assumptions across the balance sheet, cash flow statement, and P&L statement. We also calculated beta, which would be an input for our valuation. Then we calculated the income statement sheet, the balance sheet, and the cash flow, and projected all the future numbers for them. All right, the moment of truth. How do we translate those meticulously built financial statements into a company's intrinsic value? We start with the gold standard, discounted cash flow, or DCF valuation. This method is powerful because it's rooted in the fundamental principle that a company's value is the present value of its future cash flows. Now this brings us to the last lap of our financial model on the Ashok Leyland, which is the DCF valuation. So if you see over here, the very first item that I've captured is the risk-free rate. Now this risk-free rate is what we assumed in the assumption sheet. Then we have the market expected rate of return, and this is again taken from the assumption sheet. The calculated beta, which we have calculated in the beta final sheet. Now we'll compute quickly the cost of equity. So the cost of equity is the risk-free rate plus beta into expected market return minus risk-free rate. And here comes our cost of equity, which is 15.04%. We assume the pre-tax cost of debt, we took the taxes from the assumption, and we now calculate the post-tax cost of debt, which is simply the pre-tax cost of debt multiplied by 1 minus the tax percentage, 5.71%. So our WACC is calculated as per the 3 scenarios that we had taken in the assumption sheet: the optimistic scenario, moderate scenario, and the pessimistic scenario. Similarly, our terminal growth rate is also captured in the assumption sheet basis the scenarios only. Now we calculate the free cash flow to the firm, which will eventually go into the calculation of our enterprise value. So if you see, I have taken EBIT into 1 minus tax rate from our income statement sheet. Then I have taken the depreciation again from the income statement sheet. Then I have taken the changes in the working capital. Now this I have taken directly from the cash flow statement because we have it over there. Then finally, the change in the capex is also taken from the cash flow statement. And finally, we have the free cash flow to the firm for 2020. We are going to simply extend all of them towards the projected years, and that's what we get. Similarly, the calculation of the free cash flow to the firm will also be extended to the right, and that's how we compute it. Now with the last cash flow, we can compute the terminal value, which is the last cash flow in 2029 multiplied by 1 plus growth rate, which is the terminal growth rate, divided by WACC minus terminal growth rate. So here we have got our terminal value as well. Now if you see the terminal value has been computed as per the 3 scenarios again, and we are going to consume the same in our final calculation of the present values. So the present values of the future cash flows would be the free cash flow in 2025 divided by 1 plus WACC to the power 1, and so on and so forth. The last value will have a combination of both the free cash flow to the firm and the terminal value, and that's where you see a bigger term over here. Sum up all the present cash flows and we will get the enterprise value. Now basically, to get the equity value out of the enterprise value, we will deploy the formula of the equity value, which is enterprise value minus net debt minus minority interest minus cash and short-term investments. So our equity value basis all the above inputs come out to be 117,000 crores. Now these are the outstanding number of shares that have been taken. So the final share price comes down to 398 rupees when in the assumption sheet we have selected the optimistic scenario. The share price would be changed to 184, and accordingly if we change the scenario to be pessimistic, accordingly the share price will change to 79. So that's our range for all the three sorts of markets. As you can see here on our DCF valuation sheet, this entire analysis is a direct descendant of our income statement and cash flow statement. We are pulling our projected revenue, costs, capital expenditures, and working capital changes directly from those sheets. This seamless integration is what makes our model so robust. Every assumption, every calculation we have made so far now culminates in this valuation. Our financial statements are the engine, and DCF is the compass that guides us to the true north of value. It's about looking forward, not just backward. The beating heart of any DCF is the free cash flow to the firm, FCFF. This isn't just any cash flow. It's the cash generated by the company's operations after accounting for all the expenses and investments needed to maintain or expand its asset base, but before any debt payment or dividends. It's the cash truly available to all the capital providers, both debt and equity holders. Here's how we compute it step by step right here in our model. Start with EBIT, earnings before interest and taxes. This comes directly from our income statement. Adjust for taxes, we multiply EBIT by 1 minus tax rate to get no PAT or net operating profit after tax. Add back non-cash expenses. Crucially, we add back depreciation and amortization, which reduced our EBIT but wasn't a really cash outflow. Subtract capital expenditures, CAPEX. This is the cash spent on new property and plant and equipment pulled from our cash flow statement or asset schedule. Adjust for changes in the working capital. We account for increases or decreases in the current assets and liabilities, ensuring that we capture the cash tied up or released from operations. This FCFF series, projected for our explicit forecast period, sample 5 or 10 years, represents the core cash generating power of Ashok Leyland. It's the fuel for our valuation engine. Represents the core cash. But what really happens after our explicit forecast period? Companies don't cease to exist, right? This is where the terminal value comes in. It captures the value of all cash flows beyond the explicit forecast horizon. Assuming that the company grows at a stable perpetual rate, we typically calculate the terminal value using the perpetuity growth model. The formula is elegant. FCFF in the first year after the forecast period into 1 plus terminal growth rate whole divided by WACC minus terminal growth rate. Our terminal growth rate is a critical assumption, usually a conservative, sustainable rate often linked to long-term GDP growth or inflation. Our WACC, weighted average cost of capital, which we meticulously calculated in our assumption sheet in video 1, acts as our discount rate. For example, for FCFF in the last forecast year is X, our terminal growth rate is Y% and our WACC is Z%. We plug in those to derive a substantial portion of our company's total value. So again, if our last FCFF is 200 units, growing at 2% perpetually and our WACC is 10%, our terminal value would be 200 into 1.02 divided by 0.1 minus 0.2, a significant figure. Terminal value often represents a large percentage of the total enterprise value, underscoring the importance of sensible long-term assumptions. With our free cash flows and terminal value in hand, we can now compute the enterprise value or EV. Enterprise value represents the total value of the company attributable to all its capital providers, both debt and equity holders. It's essentially the market value of the operating assets of the business. To get our enterprise value, we simply discount each year's free cash flow to the firm, FCFF, and our terminal value back to the present day using our weighted average cost of capital, WACC. Each future cash flow is worth less today, so we bring them all back to the common point in time. We sum up all these present values and voila, we have our enterprise value. This is the theoretical price an acquirer would pay for the entire company, assuming they take on both its assets and liabilities. For example, if our discounted FCFFs sum to A and our discounted terminal value is B, then our enterprise value is A plus B. But most individual investors aren't buying the entire company, right? They are buying shares. So how do we get from enterprise value to the actual equity value and ultimately the share price? It's a straightforward bridge. From our enterprise value, we subtract the value of net debt, total debt minus cash and cash equivalents, and add back any non-operating assets like excess cash or investments not essential to core operations. The result is the equity value, the value attributable solely to the shareholders. Once we have the equity value, deriving the share price is simple. Equity value by total number of diluted shares outstanding. This gives us the intrinsic value per share basis our DCF analysis. For instance, if our enterprise value is X, net debt is Y, we have Z shares outstanding, our equity value is X minus Y, and our share price is X minus Y divided by Z. This is the moment of truth for stock picking. Basically, comparing this intrinsic value to the current market price. A single point estimate for valuation is rarely enough. The future is uncertain. That is why sensitivity analysis is absolutely critical. It allows us to understand how our valuation changes when key assumptions fluctuate. It's our what if machine. Now we go back to our DCF valuation, and finally we jump on to the sensitivity analysis. You see, I have taken the share price as an input, which is referring to the cell where the share price calculation is done, and all the WACC variations are calculated in the columns, while the terminal growth variations are captured in the rows. Now to do a sensitivity analysis, select the whole table, go to data, click on what if analysis, click on data table. It is going to ask you a row input cell. Now the row input cell would be the WACC, so we can select the cell where the original WACC is present, that is B12, and the column input cell would be the terminal growth rate. Click OK, and you will find the values populated over here. Now I've done a sort of color coding to see the scales where the minimum and the maximum values lie. So basically we need to ignore all the red filled values, as the model would become unstable and invalid. Now apart from that, the minimum value in the table and the maximum value in the table are as follows. The minimum value in the table is -219. The maximum value in the table is 401. Now to capture the range, we simply add the share price that we have got, which is $398, to both of these values. So if we add 398 to -219, we would get 179, while we add 398 to 401, we will get 799.87 or around 800. So our range becomes 179 rupees to 799 rupees. So this is the number that we have got as per the sensitivity analysis, while we still stick to our point range number, which is 398. Here in our model, we have built a data table that shows the sensitivity of our calculated share price to changes in the two most powerful assumptions, the WACC, weighted average cost of capital, and terminal growth rate. As you can see, by varying WACC across a range and terminal growth rate across another, we generate a matrix of potential share prices. This visually immediately reveals the most impactful drivers and the range of possible outcomes. For example, a slight increase in WACC or a decrease in terminal growth rate can significantly impact our intrinsic value. This analysis doesn't just give us a number, it gives us a range of numbers, and more importantly, it highlights the risk and opportunities inherent in our assumptions. It's about the understanding the robustness of your valuation. While DCF gives us an intrinsic fundamental value, it's crucial to cross-reference it with how the market is currently valuing similar businesses. This is where the comparable company analysis, or comps, comes into play. It's about relative valuation, comparing our target company to its peers. Let's jump onto and create our comp analysis to verify if this number is correct. So if you see on this sheet, I've already completed the comps valuation, but I'll explain how I have done that. I've selected basically the 5 peers of Ashok Leyland, which are the major players in India, calculated their current PE ratios and the PB ratios, the PS ratios, EV by sales, EV by EBITDA accordingly. And then finally, I have captured the weights of these companies as per the market cap within the industry, which is automobile industry. Now, the weighted average multiples of the PE as per the weights captured over here is shown over here. So basically PE, which is the weighted average multiple. So basically the weighted average PE multiple is 12.6256. Same, the weighted average multiple for PB is 2.5, so on and so forth. Now for the Ashok Leyland 2025 matrix, the earning per share is captured as 8.735. How I got that? From the data in 2025 from the previous sheets that I have captured. Same, the book value per share is captured again from the same sheets earlier. Sales per value also, and EBITDA per share as well. So basically I calculate the price over here by simply taking the price multiple. So for example, if I'm taking PE multiple, which is 12.6256, I'll multiply it with the earnings per share of Ashok Leyland to get the expected share price of Ashok Leyland, which is 110.28. Same, I use the PB multiple, the weighted average multiple that I calculated over here, which is 2.5, multiply it with the book value per share to get the expected share price as per the PB multiple. So this share price I got from the multiple of price per share, and then I calculated the EV from the multiples EV by sales and EV by EBITDA and calculated the price from them with the same logic that equity value should be equals to enterprise value minus debt plus cash minus any minority interest. So I've computed the price, expected price from these values as well. Now if you see the last two values which I've calculated from EV, so ignoring them, I have taken the first three values which are still not the outliers and computed the final price. On our comps valuation sheet, we have meticulously identified a pair of group companies companies similar to Ashok Leyland in terms of industry, size, and business model. We then gather their financial metrics and crucially their market multiples. We are looking at metrics like EV by EBITDA, price by earnings, price by book value. We calculate these multiples for each comparable company, derive an average or median, and then apply those average multiples to Ashok Leyland's own projected financial metrics, like its projected EBITDA or earnings per share from our income statement. For example, if the average EV by EBITDA multiple for a comparable company is X and Ashok Leyland's projected EBITDA is Y, then its implied enterprise value from comps is X into Y. This provides a market-based valuation, a reality check against our DCF. It tells us what investors are currently willing to pay for similar cash flows and earnings in the market. Now the culmination. We have our intrinsic value from DCF and our market-based value from comps. How do we arrive at final valuation? Now to get the final price from both DCF and the comps valuation, we move on to the next sheet. The final valuation over here says the weights that I'm confident on my model. So I have taken 75% of the weight of my DCF number while 25% of the weight of my comps number. This is as per the analyst discretion and the confidence in the model and the attributes, the assumptions they have used. So I've taken both the values that I have got from both the DCF and the comps, and finally took the weighted value and calculated the final share price by simply adding the weighted value. So this is the final price, and this is what we intend to reach. On our final valuation sheet, we typically present a weighted average of these two methodologies. While the weighting can vary based on specific company and industry, a common approach is to give a higher weight to the DCF as it's fundamental and forward-looking, and a slightly lesser weight to comps, which can be influenced by market sentiment. For instance, we might assign a 75% weight to our DCF-derived share price and a 25% weight to our comps-derived share price, the weighted average to arrive at our final blended share price. This provides a more balanced and robust valuation conclusion, incorporating both the fundamental analysis and market realities. So, what is the final verdict based on the intrinsic value of the share computed in our model? Now, if my market price is more than this price, then definitely Ashok Leyland share is overvalued, while if my market price is lower than the calculated price, then the share is undervalued and surely should be invested into. Let's say after all our rigorous analysis, our model suggests an intrinsic value of 365 rupees for Ashok Leyland. What does that imply? If the current market price of Ashok Leyland shares is, for example, 140, then our model suggests that the stock is undervalued. This would imply a potential investment opportunity, as our calculated intrinsic value is higher than what the market is currently pricing it at. Conversely, if the market price were around 400, our model would suggest it's overvalued, potentially signaling a hold or sell recommendation. This is the power of intrinsic valuation. It gives you an objective benchmark against which to assess the market sentiment. It's your compass in the volatile seas of the stock market. And with that, our incredible journey through the financial modeling masterclass and the financial modeling series comes to a close. From collecting raw market data to building robust assumptions, forging interconnected financial statements, and finally unlocking the true intrinsic value through DCF and comps, you have now witnessed and hopefully learned how to build a true powerful institutional grade financial model. This isn't just about spreadsheets. It's about developing a financial superpower. It's about critical thinking, strategic foresight, and making data-driven decisions that can shape careers and fortunes. Remember the discipline, the interconnectedness, and the power of those audit checks. I hope this series has been more than just informative. I hope it's been inspiring. Thank you for joining me on this deep dive into the heart of financial analysis. Keep building, keep learning, and keep mastering your financial destiny. If you love this series, please give it a massive thumbs up, subscribe to Bankers Bootcamp for more cutting-edge financial insights, and hit that notification bell. And don't forget to grab your copy of this complete, robust model by leaving your email and the feedback in the comments. Until our very next financial adventure, happy modeling.